Hey, what's going on, everybody? My name is Ryan. I'm a CPA, and today I'm going to be talking about capital gains on rental property and how you could possibly, maybe, just avoid them. But first, I would love it if you would please subscribe to my channel if you're new here, and if you find this video helpful, which hopefully you will, please smash the like button. I'd really appreciate that. And then leave me some questions or concerns, comments down in the comment section below. All right. Now, before we get started, I think it would be a good use of your time to watch one of my previous videos on the sale of your primary home and how capital gains are treated that way, because I'm going to reference that video in this video. So maybe after you finish this video, if you haven't seen that one already, go back 1 or 2 weeks and check out that video. In terms of capital gains, when you have a house, when you have a property, if you sell it for a profit, if you sell it for more than you purchased it for, then you will likely have a capital gains in which you'll have to pay taxes on. Again, how is capital gains calculated? It is the selling price minus your purchase price, minus any improvements you made to the property, minus any selling expenses that you incurred while selling. And that includes like realtor fees and commissions, title fees and all that stuff. So at the end of all those numbers, you will have your capital gains. But you're asking, well, what about the loan amounts? Like, what if you had a little bit of loan left and you pay that off? Does that get factored into reducing your capital gains? No, the loan amount does not matter, because that's money that you borrowed and you're just paying it back. I have other clients asking me, what if I just buy another house real quickly? What if I just took the money and spent it on another house? Would I avoid capital gains that way? And the answer is no. Well, there's a way that you can do that, but you can't just sell your rental property and then buy another one and say that you did something that avoided capital gains, because that process is called a 1031 exchange. It's a very formalized process that you need to do ahead of time before you sell your house. It's something that you have to get started before you sell your property in order to qualify and to properly do a 1031 exchange. That's something I'm not going to really go into detail about in this video. But just know that if you already sold your property, you can't do anything now to avoid the capital gains by purchasing another house. All right, so if you have rental property, you're probably familiar with depreciation. Now, this is actually different from capital gains. You notice when I gave you the capital gains formula, I didn't mention depreciation, because there's a different kind of tax for depreciation recapture. Capital gains, as you know, is typically taxed at 15% for long-term capital gains. If you fall under the highest tax bracket, that will be taxed at 20%. Well, depreciation recapture is taxed at up to 25%. Okay, so if you own rental property, you should be depreciating that property over a 27.5-year life. Each year you depreciate a little bit of it at a time. So when you sell the property, you have to recapture all those depreciation costs as depreciation recapture income. And like I said, that tax is up to 25% of that depreciation recapture. Now, this is important because there is a big distinction between capital gains and depreciation recapture, and I'm going to talk about why that matters in the next few points I'm going to make. As you can see here in this diagram, I kind of gave you an example of what it would be like if you had a property, depreciated over time, and then sold it at a profit. Okay, that means you sold it at a higher price than you purchased it for. You're going to see the differences between the depreciation recapture area and the capital gains area. And then in this diagram, you'll see kind of a similar example, except in this diagram, let's say you sold the property for a loss, meaning you sold the property for less than you purchased it for. Now, you still have the depreciation recapture tax, but you won't have any capital gains because you sold it for a loss. All right, so now I'm gonna give you a couple ways on how you can avoid paying capital gains tax. Now, keep in mind that both of these ways will require you to be very committed and dedicated to not paying capital gains. And keep in mind that these two methods also might even cost you more in the long run than paying the actual capital gains tax. But I get so many questions on how good ways that people can avoid capital gains. So here we go. The first one requires you to be very committed. Okay, you've had a rental property that you've been renting out for many years. You're looking to sell it now, but you don't want to pay the capital gains tax because maybe it's appreciated so much in value that, you know, the tax bill is going to hurt you. So what do? One thing you can do is move into the property. You know, you get your tenants out of there, whether their lease is up or you evict them or whatever. Hopefully you don't evict them, but you get them out of there, and then you move into the property and live there as your primary home for at least 2 years. Now, this is important because in the other video I talked about, the Section 121 exclusion requires you to live in your home for at least 2 years and to own the home for at least 2 years in order to exclude up to $250,000 of capital gains per person. If you're married, that number becomes $500,000, okay? So if you move into this house for 2 years and live there as your primary home, and then you sell it 2 years later or greater, then you can exclude a bunch of gains. Now, this is a pretty solid plan, but just keep in mind you can only do this once every 2 years, first of all, and you know, it's kind of a headache to move houses just to avoid gains and then sell it just to move again. So, like I said, this strategy can save you a lot of money, but it's going to require a lot of commitment on your part. So, maybe not the best strategy in my opinion, unless you really, you know, probably easiest if you have no kids, maybe if you're unmarried, or if your spouse is cool with it. You know, it's a huge uprooting of your life in order to do this. So many people, I tell my clients this, and many people are like, nope, don't want to do that. The second way to avoiding capital gains is to just hang on to the property and don't sell it. Obviously, if you don't sell it, you're not going to get any capital gains. But the kicker here is if you hold on to it until you die, whoever inherits the property gets to step up in the basis, which means, you know, in my original capital gains formula I told you about, where you have, you know, selling price minus purchase price, well, essentially the purchase price portion gets stepped up to market value when somebody inherits the property. If you bought your property for, let's say, $300,000, and then by the time that you die, it's worth $1 million, okay? And then you die, maybe your son or your daughter inherits the property. Now their purchase price or their cost basis is now $1 million. So if they sell it right away for $1 million, then they have zero capital gains. And they keep the entire $1 million, assuming there's no loans on the property. And this is essentially how generational wealth is built. You know, a lot of wealthy people have real estate or have a hand in real estate, some form or other, because of the appreciation in those assets. And if it gets passed down or inherited, the capital gains essentially goes away. The big real cost here is you lose liquidity. That means your money is tied up in property. You can't access it unless you sell it. So if you don't want to sell it, then it is all tied up there. If it's income generating property, hopefully that softens that issue a little bit, but that is the real cost here. These are things to think about when you purchase rental property. You know, will you be selling it soon, or do you want to hang on to it for a while, or do you want to hang on to it forever? You know, things to keep in mind. Don't just go buying rental property without a plan, without a short-term plan and a long-term plan, because that could cost you a lot of money in taxes in the long run. All right, so that's all I got for today. Thanks for joining me. And again, if you found this video helpful, please smash the like button. And if you're new here, I would love it if you consider subscribing to my channel for more useful information. All right, so that's all I got. Take care for now. Stay safe.
I hit the function, hit the rose till I hiccup. I hit the stage and leave with money that's a sticker. She picture perfect, so I told him I'm a flicker.